Hello, everyone. Today we are studying the topic of B2C e-commerce sales business accounting. B2C sales business accounting includes self-operated e-commerce, third-party merchants entering the platform. B2C sales business accounting goes through four processes. First, consumers place orders online. Second, shipping. Third, inspection. Fourth, after receiving the goods, the buyer transfers the money to the seller's account. In which of these four stages do you think we should recognize revenue? Yes, we should do that in the third stage. That is, after the customer receives the goods, he should have control and recognize the revenue, which is consistent with our accounting principle that substance is more important than form. Let's look at an example. Assume that JD.com is a general taxpayer of value-added tax. On June 4, 2023, JD.com sold piece of fitness equipment to consumer B. The sales price was 5,650 yuan, tax included. The unit cost was 2,000 yuan, and the freight was 56.5 yuan, which was paid by consumer B. Consumer B has prepaid the purchase price and third-party freight through Alipay. In the first stage, JD.com checks the order that the consumer has paid for. It should debit other monetary funds, including the price of goods and freight. The total is 5,706.5 yuan. That is for credit, contract liability. In the second stage, when the merchant ships the goods according to the order requirements, the merchant debits the goods shipped for 2,000 yuan and credits the goods in stock for 2,000 yuan. In the third stage, the consumer has inspected the goods, and the income can be confirmed at this time. The contract liability of 5,706.5 yuan is debited, and the main business income is credited, including the goods and freight, both of which are excluding tax. Their difference is included in the taxes payable and the output tax of the value-added tax payable. At the same time, the cost is transferred, debiting the main business cost of 2,000 yuan and crediting the goods shipped of 2,000 yuan. Let's look at the second example. The difference between this example and the previous one is that the consumer pays on delivery. Assume that JD.com is a general taxpayer of value-added tax. On June 5, 2023, JD.com sold one piece of fitness equipment to consumer. The sales price was 5,650 yuan. The unit cost was 2,000 yuan, and the freight was 56.5 yuan. Consumer pays for the goods and shipping costs after acceptance. Class, please think about it. What are the similarities and differences between the accounting treatment in the first example? First, when the consumer has submitted the order, there is no need to do accounting treatment because it does not involve financial transactions at this time. The second stage of delivery is to debit the goods shipped and credit the inventory goods, which is the same as before. What is different in the third stage is that, since it is a direct payment upon delivery, the cash on hand or bank deposits or other monetary funds are debited instead of contractual liabilities. The fourth step is the same as the previous one. That is, debit the main business cost and credit the shipped goods. So in comparison, what is different from the previous question is the first and third stages. Next, let's learn about the calculation of express delivery fees. Logistics companies settle freight once a month. and issue invoices at the beginning of the next month. However, at the end of the month, they need to carry forward costs, accrue freight, and credit other payables. After receiving the invoice next month, they adjust the difference between the estimated amount and the invoice amount based on the invoice amount. If a third-party merchant enters the B2C platform, how should the third-party merchant be calculated? The calculation is still based on the 4 stages of the sales process. In the first stage, when consumers place an order, the payment is managed by the Alipay platform and has nothing to do with the seller. At this time, the seller does not need to do any accounting treatment. In the second stage, when shipping, the entries are the same, debiting the goods shipped and crediting the inventory goods. The accounting of the third stage is different from that of the B2C self-operated platform. The entry of third-party merchants into the B2C platform basically involves commissions. The commissions for different categories are different. Some are 2%. Some are 5%. These commissions are all recorded in the sales expenses account. The entry to recognize revenue is to debit other monetary funds and sales expenses, credit main business income and output tax, and at the same time carry forward the cost, debit main business cost, and credit goods shipped. For example, a Tmall flagship store is a third-party merchant that has settled in the Tmall platform. It sells a down jacket for 226 yuan, including tax, and the cost is 100 yuan. After the consumer receives the goods, the payment is transferred from Alipay to the flagship store, and the commission rate charged by the Tmall platform is 5%, or 11.3 yuan. We have learned the accounting treatment of the self-operated e-commerce of the B2C platform. When the goods are shipped in the second stage, debit 100 yuan for goods shipped, and credit 100 yuan for inventory. Then confirm the income. Debit other monetary funds. That is, after deducting the commission of 5%, it is 214.7 yuan. Debit sales expenses. Commission fees of 11.3 yuan. Credit main business income of 200 yuan, and the corresponding value-added tax of 26 yuan. Through the above examples, we have learned the accounting treatment of the self-operated e-commerce of the B2C platform and the third-party merchants entering the B2C platform. Class, have you learned it? Everyone remember to follow the accounting standards when calculating, and calculate rigorously and carefully.